Hi everyone, welcome to this session titled 3 Reasons Why Value and Momentum Strategy is Trending. So this session is going to be a fairly interesting one in which we address the age-old question as to what works in the markets. Is it value investing or is it momentum investing? And who is it basically meant for, be it value or be it momentum? Also in this session, we'll be taking some key pointers as to why or when value investing works or when momentum investing works and who it is basically has been designed for. So is value moment or value investing the right fit for you, or is it going the other route, which is a shorter or maybe a more technical way of investing, which could be momentum investing. So that is going to be the agenda of this particular session. And as always, if you have any queries whatsoever, please feel free to post it in the comment box and we'll take it up at the end of the session. So now the 3 reasons why value and momentum strategy is trending. So now before we start off this particular session and take up the core topic of the session, for those of you who have joined who do not know what small cases are, so small cases are nothing but direct equity portfolios which are made up of stocks and ETFs, and all of these small cases have been designed to either track a theme, a strategy, or a very specific objective that the philosophy needs to attain. So moving on, let us first try to address as to what value investing itself is. So value investing is an investment strategy that focuses on stocks that are underappreciated by investors and the market at large. Now, what do I mean by this? So value investors then generally tend to prefer investing in those stocks which are trading below their intrinsic value. So now what do I mean by intrinsic value? Most of the companies, let us say during a market downturn or a market crash or a severe market correction, tend to trade below their intrinsic value, which means below the original value or the actual value of the stock. Now, or perceived actual value of the stock. Now, when this happens, there is a certain gap that is created in the markets. Now, let me explain with an example to make it better. Now, let us say that there is a stock which is worth exactly 100 rupees. Now, it could be worth 100 rupees by taking its book value. It could be taking its assets into consideration. It could be applying a very good or applying the standard P ratio on that particular stock. By doing all this, the value of the stock has been, let us say, or the value of the stock is somewhere around 100 rupees or the perceived value. Now, let us say because of a market correction, this stock's value drops down to 66 rupees for whatever may be the reason. Now, there is a 34 rupees gap which has been created between the actual price that the stock is trading at versus the actual price that the stock should be trading at. This 34 rupees is the gap that value investors will look at as potential profits. Now, when somebody invests or starts investing in the stock at the value of 66 rupees, at this point of time, they are not only expecting the stock's value to go up to 100 again, which would be the net profit for them, but to also start growing from there. And any profit that can be made on top of it or any growth that happens on top of it is something that value investors will be targeting. So now, this is the concept of value investing, where the idea is to hunt for those stocks in those sectors which are undervalued for apparently no reason or apparently very less reasons on the ground level. So now, if this is value investing, let us try to understand as to why value investing is trending amongst us as investors. So now, who is value investing basically meant for? Is it meant for the younger group of investors who have come to the markets, who are looking to make those kind of investments which will work out in the very short run? The answer is no. Value investing is basically meant for those kind of investors who wish to wait for or who have the patience to wait for a prolonged period of time in order for the market to realize the actual value of the stock. So now, for example, if I were to take examples of all the big stocks that are out there or the most popular stocks that are out there, value investing becomes very hard in such kind of stocks because almost each and every one of us is paying attention to the value of the stock, to the fundamentals of the stock. So for such stocks, value investing becomes slightly harder because they generally never get traded below their intrinsic value unless and until there is a solid reason for it. So in value investing, generally speaking, the hunt for those kind of stocks begin where most people are not paying attention, where generally, this is not true in all cases, but generally large FIIs or large fund houses are not paying much attention over there. And these stocks are generally ignored for the time being. So those kind of stocks make the perfect fit for value investing because over a period of time, when their earnings grow or when the market sees the potential that this particular stock has in terms of fundamentals, what will happen is that the market will start valuing it at its intrinsic value. And the stock which was trading at 66, for example, will just start moving towards the actual intrinsic value. To be able to find stocks where value investing is your philosophy, you need to first have a lot of patience because that is the most demanding factor in value investing. And you need to be able to also pick stocks or have stocks and be ready for the stock to go down even more from your perceived value. So, for example, let us say the actual stock's value is 100. You have picked it up as 66, believing that there is a 34 rupees buffer and this 34 buffer has to be corrected or this 34 buffer has to be made up for and the stock needs to go up. In real life, or in the real markets, it might not work that way because somebody else might have picked up the stock for 80, thinking that the 20 needs to be covered and that 20% is pending and the upward trend has to come. And from 80, it would have come to 66, at which point of time you would have entered, believing that 34 needs to be covered. And the person who bought it at 80 will feel that the market has been unfair because from the value of 80, it has gone down to 66 right now. So similarly, even after you buy it at 66 or take a position at 66, it might still go down from there because the market at a large or has not figured out the actual value of the stock. So here it becomes more of a waiting game. And all value investors need to go through this process to be able to stay stable during all market conditions and just be aware that over a period of time, and we don't know what that time is, it could be weeks, it could be months, it could be many years, that the only way that the market is going to realize the intrinsic value is by being patient about it. And it could take years before the intrinsic value is actually, how would I put it, realized by the stock market. So now, in spite of all this, why is it actually trending in the markets? Because if we take the likes of Warren Buffett, or if we take the likes of so many other investors who have made money in the markets, all of them have given credit to value investing. And most of them believe that other strategies might come and go in the markets, but value investing is here to stay. So the three reasons why value investing is trending and probably will always be trending. There might be hiccups here and there, but in the end, value investing will always be trending because it is a preferred strategy of investing by those investors who are looking to invest for the long run and long run only. Value investing is not at all meant for those who are looking for any sort of investing in the short run. And short run also means less than 1 year. So value investing is not the preferred mode of investment for them. And the underlying idea here behind value investing, like we had discussed, is that stock prices have to eventually come to their intrinsic value over a period of time. This is the underlying philosophy. Now, the second reason why value investing has been trending is that it is less likely to be affected by short-term market corrections compared to other strategies. I'll elaborate on this in just a minute. Now, why is it that when we look for value investing, we are not too worried about market corrections? Because when we are, or for example, let us say we have picked up 5 stocks or we have picked up 10 stocks based on value investing. Now, what is happening here? We have basically chosen those companies which have very strong fundamentals, because of which they have cemented their positions in the markets. They could be market leaders, or they could have very strong financial growth. Now, these kind of companies are generally stable by nature, and they are not affected very quickly by short-term market corrections, which could be happening because of some external factor. It could be, for example, war-based factors which are happening out there. It could be, for example, of late, if we could take an example of COVID, it could be a minor COVID infection coming out again. It could be a lot of other factors. It could be a factor which is affecting a certain sector, which is spilling over to other sectors. Or it could be generally a normal market correction which happens because the markets are overvalued. In a market correction, those stocks are affected very quickly, which generally were overvalued by the market for no reason whatsoever, because it started trending and everyone wanted to get in on that particular stock, and the stock started moving very quickly. So those kind of stocks, if you do not exit out of over a period of time, these kind of stocks will undergo a very strong market fall. But those of you who chose value investing as the way to go, you will not have that particular issue when the market starts correcting. Now, let us try to understand the third reason why value investing starts trending in the markets at all points of time. This all boils down to the risk factor. So when it comes to long-term investing helps reduce the risk in your portfolio, because attempting to time the profitable buying and selling of stocks is one of the biggest contributors of investors' losses. Now, whether we like to admit it or whether we don't like to admit it, the fact out there is that most of the time, those who are trying to time the markets eventually end up losing all their capital or most of their capital. This could be ultra short-term trading. This could be believing that the market is going to go up exactly right now. It could be trying to find the exact bottom and trying to sell up or sell the portfolio exactly during the top, or taking leveraged positions. All this eventually leads to the customer losing a big chunk of their capital, or we as investors losing a significant part of our wealth. Now, most of us might admit this, some of us might not admit this, and still believe that that is one of the key ways to make or generate wealth in the markets. But whatever it is, whatever our beliefs or thought processes are, data shows us that those who are trying to time the markets do not actually make any money. In fact, they lose a lot of money over their period of time. But value investing takes a different approach altogether. Here, we are least interested in timing the markets. We are okay to get the timing wrong. All we know is that we bought some stock or we started investing at some point of time in our life where the stock has been undervalued and the stock has to go back to its intrinsic value, or the stock has to go back to its actual value. Now, because of this philosophy, value investors do not mind the stock trading below that particular level or below the level from which they have bought it to. So they're willing to wait it out. And this is one of the key reasons why value investors do not worry about whether the markets have been going up, down, or staying flat. So now, the buy and hold strategy associated with value investing lets you avoid potential timing mistakes, which we are talking about, since most of these are a result of hasty and emotional decisions prompted by ever-changing market events. So, to sum it up, why are we getting into value investing, and why is that one key mode? Value investing is meant for these kind of people who are willing to stay in the markets for a prolonged period of time. The duration has to be many years put together. Value investing is meant for those who have the ability and patience not to keep looking at the market over and over again, who are attached to the market, who are attached to stock market prices, and who are emotional decision makers. Value investing is definitely not meant for them. So value investing is meant for those who simply know that this particular stock or this particular sector has been undervalued by the market. We do not know how long it is going to be undervalued. It can be undervalued for weeks. It can be undervalued for months. but over a period of time, we know that it will get appropriately priced. So whatever the price is right now, if I feel that the gains, potential gains, is something that is tolerable by me or something that is expected out of this particular stock, we are going to take a position in it. So this is value investing, and somebody who's coming to the markets with this mindset will find value investing to be the way to go. Now, with this said, there is a stark contrast coming in the markets, which is, this is one school of philosophy, that is value investing that we spoke about. Now, there is another school of philosophy which comes in, which is called momentum investing. Now, momentum investing takes a far, far different approach from value investing. So, to give you the definition, momentum investing is an investment strategy that is aimed at purchasing securities that have been showing an upward price trend already, an upward price trend, or short selling securities, which means taking a negative position that have been showing a downtrend. Now, to give you a very simple example, let us try to understand with an example. What is momentum investing? It is a technical form of investing, could have fundamentals combined in it, not denying that. But generally, if you look at where the investment is happening, it is more technical in nature, where the buying of securities is happening when a stock price has already started going up and is already in the upward trajectory. So here, the agenda is not to wait for the stock price to start below its intrinsic value. Here, let us say the intrinsic value is 100 and the stock price has started moving from 100 to 105 and has started moving to 110. Now, let us say the upward trajectory is very strong. Now, let us say that momentum investors believe that even though it is at 110, which is trading above its intrinsic value, let us say the trend looks like it is going to 120 and the market is also very bullish and FII money is being pumped in, DII money is being pumped in, retail investors are jumping in. There is a lot of reason to believe that from 110, it has to go to 100. Now, if a position is taken at 110, if the stock is being bought at 110, assuming that the price will go to 120, then it is considered to be momentum investing, because here you are not worried about intrinsic value. You are only worried about the short-term trend and whether the trend is going upwards and to what degree is it expected to go upwards and do you want to participate in that. This is called as momentum investing, and momentum investing is one of the new modes of investing that has stepped into the markets and become popular right now. So momentum investing is generally popular among new millennials who have come to the markets, who say that value investing works, but value investing has only a certain degree of growth prospects to it. So value investing is not going to fetch me, a CAGR or a growth potential that is as high as momentum investing. So momentum investing might have a very good growth prospect for my portfolio. It could give me, 3 times more returns than value investing, and so on. So there are many schools of thought that come here where people believe that in order to be able to make the capital grow quickly, one has to adopt momentum investing rather than value investing. So with that said, some of the key things that you need to know about momentum investing is that it is a trading strategy in which investors buy securities that are rising and sell them when it looks like they have peaked. Now, the goal is to work with volatility. What do I mean by volatility? I mean market fluctuation, the degree to which the market starts pivoting towards one direction. That is called volatility. So now the goal here is to work with volatility by finding buying opportunities in short-term uptrends and then sell when the securities start to lose momentum. Now, this investor takes the cash and looks for the next short-term uptrend opportunity and then starts repeating the process. This is all momentum investing is, where you are not attached to one stock. You may or may not believe in the fundamentals, doesn't matter much. You are looking at the trend. When the trend is right, you buy in. You try to exit when you believe that the trend has maybe peaked out, and then you cash out on it and you start moving to the next opportunity, or you start finding the next opportunity. And skilled traders understand when to enter a position, how long to hold it, and when to exit. And they can also react to short-term, market spikes that come through because of news events. It could be downward trends which come as a result of sell-offs and so many other things. So this is what momentum investing is about. Now, you have to realize, all of you who have come down to this particular session, that momentum investing and value investing, if you look at the mindset of people who are in value or who are in momentum, they're completely different. Momentum investors have a inclination towards the technical side of trading, whereas value investors have a strong inclination towards a fundamental way of investing. So this is where the mindset totally becomes different. And a value investor will most probably not agree to become a momentum investor, and a momentum investor will not agree to become a value investor. So this is the general notion or tendency that is out there in the markets. So coming to why momentum investing has become trending in the markets, is the most important factor, and simply put, is that the potential for higher profits compared to all other types of investing is very high, especially over a shorter period of time. So momentum investors tend to look for, like I said, 2 times, 3 times, 4 times growth compared to what an index is able to achieve, or compared to what something like value investing is also trying to achieve. So because here you're trying to time your entry and you're trying to make profits or trying to build wealth over a very short spike that is coming out there in any particular stock. So the potential for profit also is actually higher if you look at it strategy wise. So now coming to the second most important reason is momentum investors want to leverage the market's volatility to their advantage. And it is all about capitalizing volatile market trends. So when the markets are flat, or when some particular stock is flat, momentum investors don't find a reason to enter there. Value investors might still want to enter there because for them it doesn't matter. But momentum investors consider that period where the stock is not moving to be a wasted period of time, because they did not make any money out there, and the time has been wasted staying in that particular stock. So instead of doing that, they would prefer other modes where they are finding some sort of short-term trend coming in. So it is all about looking for stocks that are high, buying it when they are high, and selling them when they are higher before the price drops. So momentum investors are not at all looking for a stock that is trading flat, hoping that it will go up. They are looking at stocks that have probably been flat and have started trending upwards. And once they have started trending upwards, they want to position themselves here and try to exit it here before the trend, or just when the trend starts turning. Now, the third one, the reason why it has become popular is this kind of investing lets investors leverage on the emotional decisions of other investors. What do I mean by this? Now, when does a stock start trending upwards? Is it when the financial report, or is it when the financials are good? Generally not, because when the financials are good, we have realized that stocks which trade at 100, for example, can still come down to 80, can still come down to 66, because the market misprices. Generally speaking, the stocks get mispriced here and there all the time. This is very common in the markets. So the markets or any particular stock generally tends to go up, not when the financials are good or not when the financials are bad. It is when everybody else wants to participate in it. It could be FIIs, it could be DIIs, it could be retail investors, it could be a news-driven spike, it could be just the market starting to go up, which is affecting this particular stock. But generally, it is when all of them or a collective group decides to buy it within a certain time period. This is when the graph starts going up, or this is when the price starts getting spiked. Now, because of this, momentum investors believe that one of the ways to capitalize or to make or to generate wealth in the markets is to wait for everyone to start making emotional decisions and to just become a part of it and try to ride the wave. Now, this is the reason why or this school of thought has been one of the reasons why momentum investing has started trending in the markets right now, especially among those who are technical traders, especially among those who are younger in nature and those who do not have the patience to wait for a very prolonged period of time to start generating wealth in the markets. So with this said, how do we make the best of both the worlds, be it value investing, be it momentum investing, and how do we realize what needs to be done? So what we will do right now is we will head over to the platform directly and we will try to see what kind of portfolios are available, be it with respect to momentum portfolios, be it with respect to value-based portfolios, and we will try to see how we as investors can capitalize on it. Now, I'm going to show you both value-based portfolios. I'll show you momentum-based. There's a momentum-based portfolio which will also be shown to you. And we will also take a look at one portfolio which has taken both value, momentum, and both value investing and momentum investing philosophies, has combined it together. And we also have a portfolio that could that has combined both these worlds, that could be of advantage to someone who believes that both these school of thoughts can work in the markets. So let me take the middle path and try to find such kind of a basket or portfolio that is available. So now, the first thing that all of us need to do in order to be able to find these portfolios is to head over to ICICIdirect and scroll down. Under products, you will find Smallcase listed right over here, and you can click on Smallcase. So once you click on Smallcase, you will be redirected to smallcases.icicidirect.com, where all the portfolios that you wish to see will be made visible to you. So under Discover and under All Small Cases, here you will find a list of all the portfolios which are available, which have been curated keeping different philosophies in mind. So all weather investing is an ETF based portfolio where the idea is, or the philosophy is asset allocation. So something like dividend aristocrats exists, where the idea is to take positions in those stocks which are continuously increasing their dividend yield over a period of time. So now, House of Tata is a business house small case where we take Tata Group small cases and put it in. And growth and income is a different kind of small case. But the idea of today's session is to focus on value investing and momentum investing. So on the platform, let us see what kind of value-based stocks are, what kind of value-based portfolios are available and how to find it. So once you come over to this platform, when you come to all small cases, on the left side, you find something called subscription type here. Then you find investment amount in the filter section. Then you find volatility. And if you scroll down more, you find something called investment strategy. So under investment strategy, there are a lot of strategies that are listed: asset allocation, dividend, ESG, and so on. So first, let us take a look at value investing. So value is mentioned over here in the end. So when you tick on value investing, all those portfolios which are or which have been designed or which have a part of it as value investing will get listed right over here. So now let us take a look at each one of these portfolios. So let us first take a look at the third portfolio, which is growth at a fair price. So when you take a look at growth at fair price, here we are investing in high growth companies that are available at fair valuations, which, as discussed, is one of the philosophies of value investing. So a brief description of how the small case has been curated will be available to all of you right over here in the About the Small Case section. And when you scroll down even more, you will be able to see the performance metrics. So the blue graph basically shows the performance of this portfolio, that is growth at a fair price. And the yellow graph shows the performance of the respective index, which is equity small cap index. And similarly, when you click on stocks and weights, you will be able to see the rebalance frequency, the number of stocks, the last rebalance cycle, next rebalance cycle, whether it's a small cap portfolio, what percentage of the portfolio belongs to mid cap, similarly to large cap, and so on. And you'll also be able to see the minimum investment amount. Now that we have understood the basic philosophy of what growth at a fair price is about, let us take a look at the CAGR. So this portfolio has been live on the platform for 7 years, about 7 years now. And the CAGR, or the compounded annual growth rate, or the average return, as we can call it, has been somewhere around 13.18%. And if we take a look at this particular portfolio, The portfolio has more or less performed moderately when the markets are in a downturn. So almost giving an index linked return, and has started performing, I would say, or has started giving higher alphas when the markets have started trending upwards. And so far, it has given an above average market return. So the equity small cap index, since this portfolio started, that is April 4, 2016, has given a 93% return, whereas growth at fair price has given a return of 123%, as against 93% given by the small cap index. So this is one of the growth portfolios that all of us can explore. The next portfolio that we'll explore is called as the naked trader. So here, the investment philosophy is fairly simple. We invest in low debt companies, which are showing a healthy growth, which are showing very healthy growth. And this criteria has been adopted by and has been set by a trader who goes by the name of Robbie Burns. Now, this portfolio has been live for 6 years in the markets. And if we take a look at the performance of this particular portfolio, the CAGR has been somewhere around 18.33%. And if we take a look at the portfolio's performance over these 6 years, the portfolio has consistently managed to outperform its respective benchmark index, which is the equity small cap index. So now, one thing to note about this kind of portfolio is that these criteria, value investing is one concept, but inside value investing, there are a variety of ways to go about it. One, as we can see, is to go with low debt companies having high growth. The other strategy could be strong financial companies and focusing just on strong financial companies, whether their debt books are high, whether their debt books are low. It could not make much of a difference. The third factor could be high growth companies which are also trending right now, or where the sector is trending and the sector is also given weightage as to whether or not the stock has to be picked up. So there are a lot of ways in which value investing can be done. And some value investing strategies tend to give better returns compared to other value investing strategies. One such strategy is this one, which has been set by Robbie Burns. Now, let us go to the third portfolio, value and momentum. Now, before we go to value and momentum, what we need to understand is that this portfolio incorporates two components, which is both value and momentum. So under investment strategy, if we remove value and if we just take momentum, this is the only strategy that is available. So here on the platform, on the ICICI platform, what we have done is launched a portfolio called value and momentum, where it is taking the best of both worlds. Here, the idea is not to simply remain in momentum or simply remain in value, because momentum investing also has its own disadvantages. If the markets are not trending very strongly in one particular direction, then momentum investing might not be the right fit at that point of time. If the markets have slowed down, or if the markets are taking a very standard kind of approach to growing its, or let us say the stocks are not trending extremely well in one particular direction, or the volatility levels have reduced in the markets, momentum investing is not going to fetch you a meaningful return. So what we have done is combine both the words, and we have launched a portfolio called value and momentum, where we are investing in positive momentum stocks which are available at a discount to their peers. What do I mean by discount to their peers? It means that we are investing in those stocks where the valuation of these stocks is relatively less compared to the same sector stocks where the value or the market is pricing it at a very high valuation. So here we know, or we can at least estimate, that this stock also will get correctly priced by the market, because of which the value of the stock can go up. So now, if this strategy is being adopted, where we are looking for undervalued stocks, but which have started moving towards its intrinsic value, where the positive momentum has come, and we are taking a part in that particular momentum, then this becomes a portfolio called value and momentum, where we are combining both the worlds together. So, to give you a brief introduction of this particular portfolio, which is the highlight of this particular session. So here in About the Small Case, you can take a look at the philosophy. It's a mix of value as well as momentum, and can be an ideal combination when it comes to stock investments. This small case includes stocks that are undervalued compared to their peers, but have been attracting attention of late, as evidenced by their recent stock price movements. These stocks have also earned higher than expected profits during the latest financial reporting. And invest in this small case to get exposure to undervalued stocks that are witnessing momentum in their price range. And you can access the asset allocation version of the small case with better adjusted risk here. So if you click on this particular link, you're going to get more details about it. So before I go to the performance, one thing that you can take a look at is the 7-year CAGR. This is one of the oldest portfolios available on the platform. It has been around for 7 years now. And the CAGR has been approximately 24.13%. So now let us take a look at the performance of the portfolio. So the blue line is showing the performance of value and momentum, and yellow line the small cap index. Now, why equity small cap index? Why not the large cap index? Because if we head over to stocks and weights, we can see that the small cap index makes up 53% of the portfolio, and the large cap index makes up just 40% of the portfolio, mid cap having a 6.6% weightage. So because of this portfolio is being automatically compared with the equity small cap index because small cap has the highest weightage. But if you as investors want to compare it with, for example, the large cap index or compare it with Nifty 50, what you can do is click on this equity small cap option here, and in the drop down, click on equity 50, which basically means the top 50 stocks in India. So at that point of time, it will compare itself with the top 50 stocks. And the yellow line becomes that instead. So now I'm going to go back to equity small cap because that is the right comparison to do. So over here, this portfolio was launched on April 4th of 2016. And from then on, the equity small cap index from a notional value of 100 has appreciated to 193, which means from April 4th of 2016, this portfolio has, the index, small cap index has given a return of 93% because from 100 it has appreciated to 193. Similarly, if we go back to value and momentum, from a notional value of 100 since April 4th of 2016, the portfolio has gone on to achieve a total return of 307%. So equity small cap is at 93 and value and momentum achieved a return of 307%. So it has achieved more than, I would say it has achieved almost a 3x return compared to the small cap index. So what we can also do to understand the return metrics better, or if somebody wants to understand the latest 5-year returns, is to just click on the 5-year returns here. So what you can see here is that in the last 5 years, equity small cap has managed to achieve a return of only about 11%. From a value of 100, it has become 111. Which means just 11% return. 100 is over here. And value and momentum at the same point of time has managed to achieve a 95% return over the last 5 years. So similarly, if we take the last 3 years example, equity small cap has managed to achieve 67% return, value and momentum 177% return. Similarly, in the last 1 year, equity small cap has gone down by 12% approximately, and value and momentum is up 3.26%. So this is the latest 1 month return if 1 month return matters to you, and you can also check out the SIP returns over here, SIP returns over here. So why has this portfolio compared to all the other 3 portfolios, or what could be the reason why value and momentum compared to other portfolios has managed to give a higher rate of return? Now, one of the reasons could be because these 2 portfolios or value-based portfolios start working when the markets realize, that it could be a very long time. The markets have to realize the potential or the intrinsic value of all the stocks that are present in the portfolio. And that could happen over a period of time, because of which returns might take time to come. But a portfolio like value and momentum, you can see the returns right over here. The reason why it could have a higher rate of return is because it also has stocks which are strong fundamental stocks which do well over a long period of time, but it is also taking position inside those stocks when momentum is coming. So it is making best of both the strategies that are out there, which could be one of the reasons why even after such a long period of time, which is more than 7 years, being into being one of the oldest portfolios on the platform, it has managed to achieve a certain higher rate of return. So that could be one of the logic or one of the reasons why value and momentum combined could do fairly better than just one strategy out there in both bull as well as bearish market conditions. So now, with this said, I hope that the session has been quite interesting. There has been a lot of speculation out there as to when momentum investing works and when value investing works, and some or both the sides arguing with each other as to who is right and which is the right mode to adopt in the markets out there. So from my side, what I would like to say is that both these schools of thoughts have their own arguments as to what works, and both might actually work in the markets. But one balanced way to approach it is to maybe combine both of them together and to take a balanced approach. And this balanced approach might actually help us adopt the good of both the worlds. So with that said, a couple of other things to note before we head over to the Q&A section. In order to invest in any of these small cases, you need not open any new accounts. There are no new additional steps. You can just log in from your ICICIdirect account and start your investment journey. It's directly integrated with your existing broker account. So the money that needs to be invested will be debited from your trading account, just like stock investing. Stocks will be delivered to your demat account, and dividends of these portfolios will be paid to your bank account. So it is as simple as that. And there are no additional steps which need to be followed. So with that said, I would like to open the session for Q&A. And for those of you who wish to start investing in these portfolios, you do not have to do it alone. You can also, request a call with your relationship manager. Or each and every one of you will have a relationship manager assigned to you at ICICI, and you can always reach out to them, and they will guide you and help you take the next steps necessary to start your investing journey. So with that said, I'm opening the floor for Q&A. Any of you who have questions, please start posting it in the chat box, and I will start answering them immediately. So the first question is from Jatin. These examples suggest value investing is basically small case investing. Is that understanding correct? No, Jatin. So small case is a platform where different kind of ideas are adopted and portfolios are curated based on these different ideas that are out there. So one of the ideas could be value, one of the ideas could be momentum, third could be growth, fourth could be asset allocation, fifth could be something else, and sixth could be some thematic portfolio that is out there, something that is running in the market. For example, electric vehicles are going to be the future of India, future everywhere when it comes to transportation. So can we curate a portfolio by taking those stocks which are manufacturing electric vehicles in India, or are supplying parts to electric vehicle manufacturing, electric manufacturing sectors in India. So it could be ancillary companies. Can we take all such companies and make a portfolio out of it? It becomes thematic. That is also called as a small case. There will be a name to it. Similarly, a lot of strategies can be taken and made into portfolios. These are called as small cases. There are some small cases which have been designed with value investing in mind, or which have been designed with momentum investing in mind. Those are called as value-based small cases or momentum-based small cases. So they're different, but value and momentum are part of small cases, or small case, or part of some small cases. I hope that it is clear to a certain extent. If not, you can always post it again and I'll be able to answer it to you. So the next question is how to determine which strategy to target as per market condition. Is value and momentum strategy small case the solution for market timing? Okay, so let me address the first question. How to determine which strategy to target as part of market condition. So now, Aditya, let me ask you. One assumption that we have made here is that we know what condition the market is in right now. So what we really know, be it big investors, be it small investors, be it FIIs, be it DIIs, be it retail investors, all of us are always in the same boat. Nobody knows what market condition we are in. So what we know is what has the market condition been yesterday, day before yesterday, last month, last year, and from the last 5 years. What we know is historical data. If we were to choose a strategy based on historical data, that might not hold good for the future. The future can change and will change. And it is wrong to assume that we will be in a position to understand when the market has changed. Nobody knows when the market is going to change. So if it has become overvalued, there might be small minor correction, at which point of time somebody might believe that the market correction has started. Really speaking, it could be a very small market dip and the overvaluation will continue for a very long period of time. So it is impossible to understand or to perceive when the markets are, for example, surely overvalued or surely undervalued. So if it is surely undervalued, then obviously value investing will be the way to go. If it is surely overvalued and if it is going to continue and if you have that confidence, then momentum investing is the way to go. But whether it is going to be this or that is something that nobody will be able to speculate. So I'm telling you the honest truth here. So if somebody is coming to you and claiming that the market is going to be overvalued, let us just go for it, go for momentum investing. That is just his perception, and others' perception might be completely different when they're coming to the markets. So the reason why I did not address your question directly as to how to determine which strategy to target as per market condition is because as per market condition is what needs to be emphasized on, which cannot be determined, especially the future market condition cannot be determined. So because the future market condition cannot be determined, which strategy to adopt can also not be determined with a 100% degree of certainty. Some of us might have an idea of whether momentum is going to play in the next 1 month. Some of us might have an idea as to whether the markets will slow down for the next 1 month, but the next 1, 2, 3 years cannot be speculated. So with that, let us try to come to the second question. Is value and momentum strategy small case the solution for market timing? So as you have rightly put it, market timing is the problem here, and market timing has no solution. Nobody can time it. So keeping that in mind, if you're the kind of investor who is willing to wait it out for maybe 20 years, 25 years, and you believe that the stocks that you've chosen are heavily undervalued and it will get perfectly priced over a period of time, then value investing is the way to go. If you are not patient enough, and being not patient enough is something that we'll have to ask ourselves. Not being patient might be one of the drawbacks, but it also in the market, but it also tells us in a sense, what is our expectation of the market. It is not bad to be impatient in the sense that if you know for a fact that you do not wish to wait for 10 years, 15 years to be able to generate or to be able to wait to generate that much capital in the market, you do not have to. You'll have to come to that conclusion and you'll have to ask yourself. And if the answer is yes, I'm not willing to wait, then momentum investing might be the way to go. But a balanced approach is always better because we do not know when the markets are going to trend and we do not know when the markets are going to go down. This is the third school of thought, which says that I do not know where the market is going to go. It can go in any direction, but I am going to adopt a strategy which can probably assist me irrespective of which strategy or irrespective of which direction the market is going to take, or irrespective of whether the market is going to be flat, not flat, and so on. So that is the third school of thought. I will allow you to choose whichever one you want, but a balanced approach when coming to the markets always has its own advantages. So the third one is Jatin is asking, is there more clarity on the fee-based small case? Is there further guidance on sell, add, reduce in the further course? So let me give some clarity on it. So let me throw some light on it by sharing the screen and taking everyone through that question, because that's a very important question. So now I hope the screen is visible to all of you. So here I've come down to value and momentum, and the minimum ticket size of this particular small case starts from 20,000 rupees. That is 20,198. And this can change over a period of time. So over here, as you can see, if you wish to find out the pricing structure of this particular small case, you can click on see all plans and benefits, and you will be able to see the pricing structure. So here you can see that there is a plan of 2,000 rupees for 3 months, and there is a plan of 6,000 rupees for 1 year. Similarly, if we head over to the other small cases, Naked Trader is a free small case. Growth at fair price. Again, if you click on see all plans and benefit, the pricing structure remains the same. 2,000 for 3 months, 6,000 for 1 year. So here you need to be able to, in order to subscribe to any one of these small cases, you need to be able to pay the fee structure for any one of these small cases. So for a period of 1 year, if you want to stay subscribed to any of the small cases or both the small cases, the fee payment of 6,000 rupees has to be done. And this fee payment has to come from one of your bank accounts or any mode of payment as per your choice. So in order to do that, you can just click on the subscribe now button and take the step-by-step process that is being shown there. And once you make the payment, the set of stocks will become visible and the rebalance notifications will come to you. So all this we have covered in previous sessions that we have had with ICICI, and every decision that is taken, that is with respect to selling some of the stocks that are in there, buying additional stocks, which are called as rebalances, all these will be communicated to you via notifications on the Smallcase app, ICICI app, SMS, WhatsApp, email, and so on. So you can check out our previous videos where we have spoken about how rebalancing works. So that is something you can check out, and you can always reach out to your relationship manager at ICICI or drop a mail to help@smallcase.com, and we'll get back to you promptly on such queries. So with that said, thanks a lot for taking your time out and coming over to this particular session. And I hope to see all of you in a future session going forward. So thanks a lot, everyone. Take care. Bye.